So today we have a speaker from NAVs,
जी आपका आवाज मुझे आ
and
नहीं रहा
I would like to give a little brief about him. So welcome Mr. Niranjan Subhramanyam ji, who is having 20 years of experience in the financial services industry with the organization like ICICI Bank, HDFC Bank, ITM Business School, and Tata Mutual Fund. He is currently his NISM MFT CPE trainer. He has conducted more than 100 workshops on financial planning. So we will listen him. We will know about mutual fund, how to do the investment, what is mutual fund, what is the benefit. So all these concepts we will clear it. At the end of the session, we will have QA session. Okay. So you can ask the question and then we will sort it out. So welcome Niranjan ji.
Thank you, ma'am. Good afternoon, everyone.
Hand over to you.
Yeah, thank you. So, good afternoon, everyone. On behalf of NJ and Access Mutual Fund, I welcome all of you all to this session on mutual funds. Right. So, we will try to understand what is a mutual fund, how it will help you all, and what are the benefits of investing in a mutual fund. Right. So, first, let us try to understand what is a mutual fund itself. Right. So basically, mutual fund is a pool where investors see when I want to create wealth, right? I need to get returns which are more than that of inflation, right? So that's what we know. When I want to create wealth in the long run, I need such an investment which will help me to create wealth in the long run, better than inflation returns in the long run. And today, one of the best investments to invest in is equities. Right, especially in Indian equities, we have seen that in the last 15, 16 years, they have given the indices, that is my BSE 30, Nifty 50, have given close to 15-16% CAGR returns over the last 15, 16 years. And if you see, it is one of the best performing asset classes in the world. Globally, the Nifty 50 and the BSE 30 Sensex, they have been amongst the best performing asset classes in the world. So now the question arises, how do I invest in these assets so that I can get the benefit of better returns? One of the ways to invest it is directly invest it in the equity shares of the company, right? But a question arises is, do I have that knowledge or expertise that I will be able to identify the right company to invest in it, right? So that is the big question people ask. Do I know whether I'm investing in the right stock when I'm investing in the right company? Right? And hence we get scared or we are hesitant to invest sometimes and we lose out a lot. However, when I'm investing through mutual funds, right? When I'm investing through mutual funds, basically what I am doing is I am giving my money to a professional fund manager, right? So basically mutual funds, as we know, is a pool where investors across the country, across the world, they pool their money through a fund, to the fund house. And the fund house appoints a fund manager who is a professional fund manager who manages your monies, then invests in those securities which we want, generates the returns and passes on the returns back to the investor. Right? So basically, this is what a mutual fund is. A mutual fund is nothing but a tool where an investor, instead of directly taking exposure in the capital markets and investing on their own, decides to outsource their investments to a fund manager who will invest on your behalf, right? There will be some charges for managing this fund, but I have to tell you, in India, the mutual fund industry is perhaps one of the best regulated financial services industry in the entire country, right? So, and all the charges, everything are capped. For example, in India, maximum a fund house can charge for managing the money, a mutual fund can charge just 2.25% per annum. They cannot charge anything more than that, right? So this is another advantage, that this is a very affordable way for investors to invest in mutual funds and get exposure to multiple securities. So now, what are the benefits of investing in mutual funds? As I said, it is very well regulated and transparent. The mutual fund industry, as I said just before, in India, is perhaps one of the most well regulated and tightly regulated industry in the entire country. Our regulator, who's SEBI, is perhaps one of the most proactive regulators when it comes to managing mutual funds. Why? Because mutual funds manage the public money, right? But it's not its private money of the promoters which are managed in mutual funds, right? Mutual funds manage the public money of retail investors, small investors type, big investors type. Hence, to protect the small investors, the regulator has been very, very proactive in taking steps which are very, very investor friendly, right? And what are some of the steps is that, say today I invest my, say Monday I put my investment in the mutual fund. I will get to know every day what is the value of my investments, right? This may be a big plus point. I will get to know every day what is the value of my investments, right? They are very transparent in the sense every month by the 10th or 15th of every month, you will get what is known as a portfolio or fact sheet, which will tell you where your investments are. It will give 100% disclosure of all the companies that are investing in, right? And this will come to the investor every month in their email. So this way, an investor knows where their money stays invested in, right? So this is again a big advantage. It is very well regulated. The regulations are such that in the last 25, 30 years of Indian mutual fund industry, investors have, there has been no instance where investors have been defrauded or cheated. So this is again a big plus that in the last 30 plus years of Indian mutual fund industry, there have been no instances where investors have been cheated or defrauded by anyone. But that's transparent and regulated. Investment varieties. See, the beauty of mutual funds is an investor has got different options to invest in. If an investor wants to invest his money in growth option, in the sense he wants to create wealth, he has got the option of equity mutual funds, where they can invest and in the long term create a lot of wealth. If the investor wants to protect his money or save his money, he has got an options of debt. If an investor wants a mix of growth and safety, he's got what is called as a hybrid fund. In India, we also got mutual funds that invest in gold and silver, right? So instead of physically buying gold, silver, you can buy gold, silver through mutual funds and keep buying. So what the advantages in a mutual fund, in Indian mutual funds, investors have got multiple options to decide what kind of risk they want and accordingly what kind of investments they want to make, right? Then choice of receiving incomes. So in mutual funds, you have got two major ways of receiving income. One is the growth option, the other is the dividend option, right? So in growth option, what happens is whenever the fund manager makes profits, he reinvests that money into the scheme and ensures that the investors' value of the units keep getting higher and higher. The other option is the dividend option, right? In the dividend option, what happens is when the fund makes a profit, fund manager makes a profit, he returns that profit back to the investor in the form of dividends. So an investor has got two choices. He can take the growth option or he can take the dividend option. Then I've got what's known as professional money management services. The people who are managing the monies, right? They are people with a lot of experience. Previously, they would have worked as research analysts, macroeconomic analysts. Then they come into the fund management industry with very good credentials and background. These are people who got 10, 15, 20, 30 years of experience who manage the money. Affordable investments. This is again something which is very unique to our country and our mutual funds is that in India, the minimum investment for investing in a mutual fund is 500 rupees, right? So it is very accessible to everybody. It is not that it is restricted to only a few people with a lot of money. In India, it is a very democratized way of investing where anyone and everyone can invest in mutual funds because of the low investment values. Diversification. This is again a very big plus. Is that suppose I open a fact sheet, we will see that a fund manager will have minimum 15, 16 or 20, 30 stocks in the portfolio and can go up to around 80, 90. On an average, an equity mutual fund will hold anywhere between 40, 50 stocks in their portfolio. But this is again another advantage that people with limited resources can get exposure to at least 30, 40, 50 stocks in their portfolio. Right? Minimal paperwork. This is again something very unique and very big plus is that thanks to technology, at least in India, the entire process of onboarding a client has become very easy and investing in mutual funds has become very easy with minimal or zero paperwork, right? Tax benefits, it is more for the Indian investors, right? So that is the, and investment strategies. So investment strategies basically is that an investor can get exposure to multiple fund managers, right? So as we know, every fund manager who's there comes with their own unique investment style, unique investment strategies. So by investing in multiple mutual funds, an investor can get exposure to different investment styles, different investment strategies of different fund managers. So these are the benefits of mutual funds. One of the downside of a mutual fund is that an investor will not get a portfolio customized to their needs, right? So the mutual fund, basically what happens is the fund manager will construct the portfolio and the investors will have to invest in that portfolio only. They don't have a choice of any of a customization. That is perhaps the only downside of a portfolio. So now what are the different type of mutual funds that are available? Basically in India, right? If we talk about Indian mutual funds, we have got 5 major categories of mutual funds and a combined total of 44 different kind of mutual funds that an investor can invest in, right? So first, starting off, it is got equity mutual funds. So equity mutual funds are those funds which will invest a minimum of 65% of their fund in those companies which are listed on the Indian Stock Exchange. That is your NSE or BSE or MCX, right? So an equity mutual fund is that fund which will invest a minimum of 65% of their money in those companies which are listed on the Indian Stock Exchange. Then debt mutual funds are those funds which invest 100% of their money in fixed income securities, such as government bonds, corporate bonds, bank bonds, so on and so forth, right? There are what hybrid funds. Hybrid funds are those funds which invest compulsorily in a mix of equity, debt, and funds also invest in commodities, right? So hybrid fund is what we call it a multi-asset fund. So multi-asset fund basically invests in minimum 2 asset classes, most common is equity and debt, then solution and others. These are the different kind of funds. Today we will be focusing predominantly only on the equity funds, right? So before we so if we have to look at mutual equity funds, we have got 11 different categories of mutual funds, right? We have got 11 different categories of mutual funds, out of which 10 of them would be more of value. The 11th, tax saving, is something which is very specific only for Indian investors, right? So if I have to talk about mutual fund, we can classify them based upon the market capitalization or based on their investment strategy. So now what do we mean by market capitalization, right? So there is a standardized format, the definition of what is market cap, which has been defined as per the regulator. So basically what is market cap, if you have to give a simple idea, is total number of stocks, that is total number of outstanding shares that is there in the company into the market price of the company. That is what is the market cap of the definition. So now how has the regulator defined the market cap, which we mutual funds in India have to follow? So if I have to talk about large cap, basically it means that the first 100 companies in terms of market cap. So basically it is your top 100 companies by market cap is called as large cap companies. Then the 101st to 250th company by market cap is known as mid cap companies. And any company which has got a market cap lower than that of the 250th company is defined as a small cap company, right? So this is what is a standardized definition of a mutual fund, large market capitalization, which is applicable for all Indian mutual funds, right? So this is what it is, very standardized now, so that there is no confusion in the minds of the investor. What is large cap, what is mid cap, what is small cap? So based upon these market capitalizations, we have got around 6 to 7 different kind of mutual funds. First, starting off with a large cap fund. So a large cap fund is that fund which will invest a minimum of 80% of its money in large cap stocks. Then I've got mid cap funds. Mid cap funds are those funds which will invest a minimum 65% of its money in mid cap stocks. Then I've got large and mid cap stocks funds. So large and mid cap fund will invest minimum 65% of its AUM in large cap and mid cap stocks, and the balance depending upon the fund manager in any of the stocks. Then I've got small cap stocks funds. So small cap funds are those funds which will invest in a minimum of 65% in small cap stocks. Then I've got a category known as multi-cap and flexi-cap funds. So multi-cap funds are those funds which are mandated to invest minimum 25% in large cap, 25% in mid cap, 25% in small cap, and the balance 25% depending upon the fund manager view, either large, mid, or small cap. And then finally, we have got flexi cap funds. So flexi cap funds are like your multi cap funds, but the thing is, in a flexi cap fund, there is no market cap restriction, right? For example, the fund manager is very bullish on large cap stocks. He can go 100% large cap. But he's very bullish on small cap stocks. He can go 100% on small cap, right? So flexi cap fund gives the fund manager flexibility to invest in any kind of stock he wants, whether it is a large cap, mid cap, or small cap. Right? So these are the funds which are that. The others we will not talk about it. If you have any questions on that, we will take it up in the questions one. Right? So now, why should I invest in mutual funds? Basically, you have to look at today, the scenario is, as you are aware, India today is perhaps the fastest growing country in the world. Just yesterday, our GDP numbers came out and we are growing at all. I think our growth came at almost 7.8% per annum, right? And annualized for the quarter, and annualized it is almost 7.2, 7.3%. Today, we are the fastest growing country in the world. And it is projected that India for the next 15, 20 years will continue to remain the fastest growing country in the world, right? And why we are going to continue remain growing the fastest country in the world is very simple, that today we are perhaps the most populated country in the world, 135 crore population and growing. But the key over here is that we are a relatively young population, right? And as you are aware, a young population is where the work is also a working population, right? We are a young and working population. And being a young and working population, we earn money, we spend money. And it is this money which is being spent is what pushes up the Indian growth, right? And this is expected to continue to contribute to the future growth of the country. And that is where people also have accepted. Today, we are the 5th largest economy in the world. And it is projected that in the next 3 years, 4 years, we would become the 3rd largest economy in the world, right? And which better way to capture this entire growth in the Indian economy than invest in the capital markets, in the shares of the companies which are going to stand benefited from this growth, right? So this is where we look at investing in the equity markets, is to capture the entire growth story of the Indian country, right? So now the question people ask, how do I invest in these mutual funds? Do I put all my money in one shot into mutual funds, or do I put little money, right? The problem now, people, many at least here they will ask, but today market is at 75,000 all-time high. What if I invest now, the market's correct, right? The answer is very simple. Don't put all your money in one shot. Spread your money over a period of time. Spread your investments over a period of time. You don't have to put all your money in one shot, because equity markets, as we all know, are very volatile in nature, right? Suddenly they can crash down, suddenly they will go up. When they will correct, when they will go up, I don't know. But one thing is very clear: if we stay invested for the next 5, 10, 15, 20 years in the Indian equity markets, there is a almost sure shot creation that we will create wealth and we can become rich. So now, how do I ensure that this volatility in this market is my friend? not my enemy. How do I make this volatility in the market my friend? How do I make this market corrections an opportunity to accumulate more units and make more wealth? Is where we come with this concept known as systematic investment plans, or SIP. So what is this concept of an SIP? What is SIP basically? SIP basically means that I am committing every month, right? In an SIP or a systematic investment plan, I am committing every month that on a fixed date, a particular amount will get debited from my account and get invested into the mutual funds. So basically, I am going to be authorizing my mutual fund house that every month on a specific day to debit a specific amount of money from my account and invest it into the mutual funds. So what happens is very simple, that whether the markets are rising or markets are falling, it won't bother me much. Because in a rising market, my existing units will give me more returns. In a falling market, we say that what we call the power rupee cost averaging. In a falling market, I will be able to capture more units, which will give me better returns in a rising market. Maybe I will just explain this concept of SIP with a simple example, right? Suppose let us assume that, say, you have a budget of, say, every week you are allowed to spend, let me give an example, say 200 rupees a week on buying tomatoes, right? So you have one day, so every Sunday you go to the market and you have a fixed budget that I cannot spend more than 200 rupees for buying tomatoes. So say today, say in India, let us assume that today tomatoes cost, say, 20 rupees a kilo. So with this 20 rupees, so today is a Sunday, I go to the market, I am able to buy 20 kilos of tomatoes, right? Because it's 20 rupees. So I'm able to buy, 10 kgs of tomato today. Say next week, I again go to the market. But now the tomato prices have gone up, say from 20 rupees a kilo to 40 rupees a kilo. But my budget remains fixed. I can buy only 200 rupees worth of tomatoes. So then I am now able to buy, last week I bought 10 kilos, now I'm able to buy only 5 kilos. So then third week, again, I go to the market. By then the new crop of tomatoes have arrived and tomato prices have crashed to 10 rupees a kilo. So now with this fixed 200 rupees, I'm able to buy 20 kilos of tomatoes, right? That is how my SIP works. So when the markets are going up, the value of my investment also goes up. But because I'm investing a fixed amount, I get lower units. When the markets come down, maybe my existing units are giving me a little loss, but then the newer units, I am able to buy more, right? The newer units, I am able to buy. Okay. Have you been able to see the slide on the SIP advantages now? If you can, somebody can just unmute and confirm.
Yeah, the
Yes,
SIP
yes, we can see that.
advantages slide. That
Yeah,
4 square
okay.
are there. Yeah.
Yes. Okay. Thank you.
Yes,
Yeah.
thank you.
Yeah. So basically, this is what an SIP does, right? So see, as an investor, my biggest fear is what? That, oh, if the markets fall, my existing investments will give me more losses, right? That is the fear. But look at this as an opportunity, that if my market is correcting, the value of my investments are coming down. So today, with a fixed amount of money, I can buy more units. And let me show you the example. So this is an example of our fund, right? So if you look over here, I've given the example of what happened in 2020 because we all know that was the time when the markets corrected by almost 30%, 40% in 1 month. If you remember in March 2020, right? Because of the COVID. So if you look over here, the first three, Jan, Feb, March 2020, my NAV was going up, right? It was 32, 34, 34. But in April 2020, the markets had corrected by almost 30% and my NAV cracked from 34 to 23. So now imagine as an investor, you would be sitting at almost a 30% loss on your existing investments, right? But look, the new investment, you made it at a 30% discount. And look at the number of units that you got. The older ones, you were getting only 292 units, but the newer units, you got 418 units, right? And we know that the market went up after that. And see, currently, this is what the situation is. This is as of 31st March 2024. See, this investment which I made at the bottom of the market is given me the highest returns today, right? See, what I'm trying to tell here is I cannot predict. I don't think any one of us in our life would have predicted that the markets will crash by 30% in 1 month. But that was actually an opportunity for people to invest, because that day when you invested at this lower value, you got double, almost 1.5 times the units. And look at the difference in returns. A 1 month difference has given you almost 11,000 on 25,000 is what? 25% difference in returns, right? So this is what an SIP does. When the markets are rising, I will still make returns, right? But the biggest plus of an SIP is I cannot predict when the markets will fall. But when the markets are falling, I am still investing at that time. I stand to get benefited because I know that in the next 2 to 3 years, the Indian markets are such, our economy is doing good. We will recover. And when our economy recovers, the stock markets will also recover. So when the investments I make at the lowest market value, right, will tend to give me the highest returns. But as an investor, I cannot predict when the markets are going to correct, why the markets are going to correct, if the markets are going to correct. So that is why we say, don't bother about the market level. If the market is rising, great, I make more profits on my investments. If the markets are correcting, great, because I'm getting more units at lower value, which later on in the next 3 to 5 years will help me to generate the best returns, right? And that is what a disciplined monthly investment does. And that is what we get to do through what is called as a systematic investment plan. Is that whether markets are high, markets are low, I as an investor, I am indifferent to that. I am focusing towards my financial goals. That, okay, I want to get this money out after 10, 15, 20 years. So today I'm investing. I'm not bothered about the market levels, because I know that if I stay invested for the next 10, 15, 20 years, I stand to get very, very good returns, right? So the question people will ask, when do I start investing? The answer is very simple. Any time is the right time, but the earlier we start, the better it is, right? So here we have given certain scenarios where we have assumed that the market will generate around 12% CAGR returns, right? So if we say over here, somebody who's starting an SIP at the age of 25, he will have to invest only 15,000 rupees per month from 25 to 60, that is 35 years, to generate a corpus of 10 crore rupees. But if that investor delays his investment by 5 years, instead of investing at 25, he delays it by 5 years, then he has to do an SIP of 28,000 to get this 10 crores. And if he delays it by additional 10 years, that is, instead of starting to invest at 30, starts at 40, then the investor has to invest 1 lakh rupees a month to get his 10 crores when he turns 60, right? So basically what we are trying to tell here is, start early so that you can commit lesser amount of money to achieve your targets, or give money time to grow. Give your money time to grow, right? Many a times we have seen it here, investors complain that, sir, I've been investing regularly, but I hardly see any returns, right? For example, say if suppose an investor invests 30,000 every month. So his first 50 lakhs comes in 8 years, 3 months. You will say, what is so great about that? So 3,60,000 into 8 is how much? 3,60,000 into 8. 1 second, I'll just compute it. So if you say 3,60,000 into 8, right? 3,60,000 into 8. That means an investor in 8 years has committed around 30 lakh rupees and it has become 50 lakhs in 8 years. You will say that is nothing great. But then look at the second thing. First 50 lakhs took 8 years to come. The next 50 lakhs comes in the next 4 years, right? So that means the investor would have committed 3 lakh 16 into 12. That means he would have committed only 43 lakh rupees in 12 years, which would have grown to 1 crore. So basically what we are trying to tell over here is that creating wealth is a long-term process. You will not be able to create wealth in 3 months, 6 months, 1 year, 2 years. You will have to wait for at least 10 to 15 years to see a substantial wealth growth in your portfolio. What mistake many people do is they invest for 1 or 2 years, they don't see the returns and they get out. But please understand, the true wealth happens only when the investor stays invested for long-term horizon. And if you look at India, there are enough examples of where if any investor has been investing in the last 20, 25 years in Indian mutual funds, today they have become multi-millionaires, right? They have become multi-millionaires. There are so many mutual funds which have made investors multi-millionaires, but had they been invested for 20, 25 years, right? So please understand the wealth creation or what we call as power of compounding is a slow process. It will not happen overnight. It will not happen instantaneously. It takes time. So when you give time for your money to grow, you will get rewarded in the long run. So this is what it is. Be patient with your investments. That is when you can create wealth, right? So I think with this, we have more or less completed this session. If you have any questions or queries, feel free to unmute yourself or you can type the questions on the chat box. We'll take up those questions.
Niranjan sir, you can mention like what is the process, how to open the mutual fund account?
Okay. See, for opening a mutual fund account, you will need to do your KYC done. That is know your customer, right? So if suppose you're an NRI, I think you will need certain documentations which need to be provided, like your address proof and all those things, and account, NRI account and all. So that all those things you would need to do. So the exact process, I think I'll have to just once. Yeah.
Can I speak one thing?
Yes, sir, please. Yes.
Hi, I'm Vikas. Presently, I'm working for Bank of India. In fact, thank you very much for your nice information. In fact, I'm witnessed about almost 25%, 20 to 21% growth because I am investing since 2007. Okay. Many of our investors like us think about that they don't need the financial advisor. But I know the importance of advisor because earlier I was getting almost 14 to 15% return. But after getting the suitable financial advisor, expert advisor, it's reached up to 20 to 21%. So can you please elaborate more about this? Why should I need the financial advisor to maximize my return?
Yes, sir. Surely I can do that. See, what happens is, as sir rightly said, right? See, today, if you're investing, say, in Indian mutual funds, I have got around 43 asset management companies. And each asset management company will have around 40 different kind of mutual fund schemes which are on offering. So that means an investor will have to choose from almost 1,600 or close to 2,000 different kind of mutual funds to choose, right? And so much choice will make an investor very confused. So this is where a financial advisor will play a very, very important role. First, in helping you as an investor to identify why I am investing in mutual funds. Why do I need this mutual fund? Am I investing in the right mutual fund? Right? They are like your guide. They will guide you in the right way to ensure that you all invest in the right mutual fund so that you all are able to get returns in line with your financial objectives. So that is where It is like a doctor, right? Why do I visit a doctor? Today I can do Google search and type in the symptoms, get the medicine from Google. But still we go to the doctor. Why? Because the doctor has done his 5 years of MBBS, 2 years of MD. He knows or she knows what exactly the disease is and give you the right medicine. We may get the same medicine from Google, but we trust the doctor because they have that experience. The same way, the financial advisors who are there are people who have been who are in this industry, who have got a lot of experience, who track the financial markets, who understand your needs, your requirements, and then suggest the right fund for you. So that is why they are needed. Otherwise, we will end up just investing anywhere and everywhere and not getting a good experience.
Thank you, sir. Thank you very much for that. And two more questions are there from my side. A
Yeah.
few of mine going to retire very soon, maybe within a year or two. So because you know that mutual funds is subject to market risk, and can mutual fund be the right investment for them? That is one question. And the second one is age means it is interrelated also, that is age can be deciding factor for choosing the type of fund. Means like if I am 25 year old, then I should select on more aggressive like mid cap or small cap. And if I am almost 50 to 53 per year old, then maybe the large cap may be the right option. So these two questions means for retirement side and for the age to choose the for type of fund.
Okay. So for an investor who's close to retirement, right? They have worked their entire life. They have accumulated their corpus in the form of retirement benefits and all that. So for them, what is their major objective? After they retire, they want a product which will give them regular income, right? And also that the corpus will grow in higher than inflation. So for that also mutual fund, there is a product solution on a hybrid funds, right? So what are these hybrid funds is, as I said, these are funds which will invest in a mix of equity and debt in one fund. So the equity part will give you better than inflation returns and the fixed income part will provide you a stability. And in India, we have this concept which I just explained, SIP, systematic investment plan. The reverse is also there, which is known as a systematic withdrawal plan. So what happens in a systematic withdrawal plan is that, say, suppose I'll give an Indian example, I've accumulated a corpus of 5 crore rupees. I am 60, and out of, say, this 5 crores, I put 3 crores in a hybrid fund. Then I give a instruction to the mutual fund that on, say, 1st of the month, every month, I will need you to redeem 50,000 rupees from the fund and credit it to my account. So now what will happen is this is like a reverse, right? Then SIP, I'm instructing the mutual fund to debit my account and invest in the units. In a systematic withdrawal plan, I'm instructing the mutual fund house to sell that much money, equivalent of units, and credit my account. So through the systematic withdrawal plan in a hybrid fund category, an investor can get regular income and also ensure that his capital gets relatively protected or gets better than inflation returns. So even for a retired investor, we have got a product, we have got a solution from which he can keep his money and get regular income. Now coming to your second question, normally, yes, the thumb rule says that younger people, because they can take more risk, are advised to take aggressive funds. Older people can take lesser risk, so less aggressive funds. But here again, we must understand why is the investor investing, right? So you give the examples of a 25-year-old and of a 50-year-old. So say today I am a 25-year-old person, I am working, right? But I have got a housing loan on my head, a car loan on my head. I have to support my family also, my parents and my spouse and my children. So although I am young, I cannot take too much risk. I will invest in equity, but in a conservative equity. And say the 50-year-old person, he is retired. He is going to 55, is close to retirement. His children are well settled. He has no financial obligations in his life, right? He is well settled. He does not want that money right now. He can take more risk. So then in that scenario, we can look at the situations, right? So please understand the type of fund depends upon what kind of risk you are willing to take. Or say you are a 70-year-old person, you want to invest in your grandchild's name. You don't want the money, but say you have just become a grandfather, you want to invest in your grandchild's name who won't need the money for the next 20 years. In that scenario, instead of large cap, mid or small can also be given. So it is very situation oriented. And this is where your financial advisor will come to guide you on where to correctly invest.
Okay, sir. Thank you. It's very much clear.
Sir, I am Ganesh Murugan here. I have a question.
Yes, sir.
See, I listened to you about the systematic investment plan. That is, suppose a particular month every year I have to invest, right?
Yes.
So whether is there any flexibility for me, for the investor, I can choose a particular month in a year to invest that money. Suppose example, I committed 10,000 every month for SIP. Okay.
Yeah.
So this year I paid during the month of May. So next year I am also watching the market. I thought the market is going to come down on September. So in the September can I advise my fundraiser that I will pay you on September. During that time you can invest in the market. Is that possible? Is there any flexibility available for any scheme?
See, in India, mutual funds advantages, I've got the option of a pause. Right? So say today I have set up an SIP. Say, let us take an example. I have set up an SIP for the next 5 years. So every month I'm committing 10,000 rupees. But then 1 month you feel that I want to just pause my SIP. So say you feel that the markets are very volatile. I don't want to invest now. So there is an option called as an SIP pause, where you can tell the fund house, okay, I don't want to invest. I'm pausing my SIP for this 1 month. And then you can restart later. So there are multiple options available in the mutual fund space, which the financial advisor can guide you on all these options in the right way.
Okay. So during the investment itself, I have to choose, I have to go through pause options. Suppose today, this month, I am pausing a particular month, say example, June, I am pausing the investment. So next month, I have to invest 20,000, right?
No, you can invest 10,000 or 20,000 if you want to. It is left up to you. Yes.
Okay. Well, how many months I can pass? Suppose it is flexibility, I can pass for 2-3 months continuously, then I can invest continuously.
I think that will depend from fund house to fund house, so that your financial advisor will be able to guide you better.
Okay, fine. This pause scheme you are saying, SIP, we have a pause option. Could you name the scheme which I can look into?
Every scheme has got that.
Okay. Okay.
Every scheme, you can pause, you can restart, you can stop, you can increase, you can decrease your SIP amount. You can do all these things in a mutual fund.
Thank you, sir. Thank you.
Yeah.
Any more question? Switch on your video, you can ask the question.
This is Radhakrishna here. I just
Yes,
wanted
sir.
to have well explained, and they totally flawlessly it has been explained. However, one question over arises here is, no mutual fund or the advisor will advise about the exit loads, which is very high, because exit load function happens based on the total amount. Because while entry load you are calculating 2 to 2.25%, whereas the exit load is high. When you compare with the return, my return is per se 2020 I invested 100 rupees in the mutual fund. That time you have taken a load of 2% to manage the fund, and today it has become 10,000. So 10,000 on exit load, you are again charging me exit load on the total quantum of not 10 rupees, 100 rupees, because you are managing all along. For managing, you are already charging. Again, exit load you are charging. Why the mutual funds are not exposed and express this view? Can you elaborate that? Because basically what happens is your CAGR is nothing. Actual return and the compounded annual growth return is two are different components. It has been calculated in a different way. Okay. Actual return. What is the actual return? The return basis is how much I've invested, how much I've returned. That's it. compounded annual growth, anybody can get share. Even in the mutual fund, not only mutual fund, in the FDR, in the RD, we are also populating the same thing.
Yes,
Can
sir.
you explain that, please?
Okay. Sir, see, in India, we don't have entry load. What you're talking is fund management charges. What I told, maximum of 2.25%, right? So in India, how it happens is, so say today I've got 1,000 crore fund, the charge is 2.25%. As my fund size keeps increasing, the expense ratio comes down. This is mandated by law. So as my AUM keeps growing higher and higher, my fund expense ratio will keep coming down regularly. But talking about exit load, most funds, equity funds, have a maximum exit load of 1%, and that too if you exit within 1 year. If you hold your investments for more than 1 year, normally Indian mutual funds don't carry exit loads. Until only if you exit before 1 year, and that too it is fixed at 1%. If you hold for more than 1 year, then there is no exit load levied. But the only charge that comes to an investor is my fund management charges, right? And the returns that you see today are after adjusting for your fund management charges in India. So
Sir,
this charge,
Sir, just a small inquiry. See,
yes, sir.
when you said about the exit, 1%, what you are saying,
Yeah.
you are charging that 1% because it's a SIP. SIP normally happens for 3 years, more than 3 years. Most of the mutual funds work for the 3 years and above. Okay.
Yes.
Normally, nobody works with the 1 year or 2 years.
Yes.
Okay. Any prudent mutual fund advises for minimum 3 years.
Yes.
Okay. And maximum of 10 years. Whatever
Yes.
I have seen, I don't know how many people are taking more than 10 years. I don't know. But normally it is 3 to 10 years. See,
Yes,
on
sir.
the third year, because SIP is running, when the exit load comes, do you consider that there is no exit load on the 3-year SIP, or you said rightly, after 1 year, there is no charge, but SIP is a continuous process.
Yes.
Radha, what I feel that exit load जो हमको लेवी होगा वो लास्ट 1 ईयर की जो SIP रहेगी उस पे होगा. मींस लाइक
Yes.
मैं 10 years पर SIP में मंथली कर रहा हूं, और अगर मैंने 10 इयर्स के लिए किया तो वो 9 इयर्स की SIP पे नहीं करेगा. जो लास्ट की 10 मंथ्स 12 मंथ्स की SIP है, जो मेरा 1,20,000 है, उस पे 1% लगेगा. दैट इज 1,200 रुपीज. एम आई करेक्ट?
Yes, sir. Yes, sir. उसी पे लगेगा. Only of the last 1 year का लगेगा, not of the entire investment. Your exit load is applicable only if you redeem your investment before 1 year. So जैसे आपने एग्जांपल दिया था कि आप 10 साल से कर रहे हो SIP, so which is your first SIP will not have an exit load, but only the last 1 year. Suppose you redeem completely today, so only the last 1 year what investment you have made, that they will charge a 1% SIP exit load. The previous 9 years there will not be any exit load charge, sir.
Okay. Okay.
Yes, sir. Yeah.
So you mean to say one is the growth funds are the good, and for
Yes.
the retirees, as Vikas has asked the question, you have responded to that. Near future retirees for the debt fund as well as the equity, both a combination has to be calculated, and it is
Yes.
advisable at the early age you have continuously investing. That will give a
Yes.
good return. That is what the essence of your lecture. Am I right?
Yes, sir.
Thank you. Thank you. Thank you.
Thank you, sir. Thank you, sir. Yeah.
Any more question?
Hello, this is Shivani here.
Yes, ma'am.
Basically, I'm a very newbie at this, so it's just my
Okay.
beginning. I'm trying to understand what mutual funds are. And as a young investor, I don't have that much funds with me at the moment, right?
Yeah.
So, and at the same time, there's so much online that we have all these apps and everything. They're very lucrative. So how do I find the perfect financial advisor for me? Should I go with the apps? Should I go with the person? And what is the best advice for a young investor who has like zero knowledge and has just started now?
Okay. See, in your case, we always say go with a financial advisor, a person, because then the person will be able to understand why are you investing for, right? So as a youngster, first time investor, you will have a lot of dreams, right? For example, maybe you want to make a down payment for buying a phone, for a car. You want to save up later on for, say, a lot of objectives, right? So based upon that, you can start investing in mutual funds. And the best part about Indian funds is that you don't need a lot of money. You can start your investment with as low as 500 or 1000 rupees also. You don't need a lot of money to start investing in Indian funds. You can start it off at as low as 500 or 1000 rupees. And I will say, speak to a financial advisor, because apps, what will happen? They will just recommend you the fund you invest. But a financial advisor will try to understand your needs and create a investment as per your requirements, so that you get a good experience about investing. So it is always suggested, speak to a financial advisor who will come sit with you, understand your needs, and create your investment portfolio for you. Yeah.
Shivani, are you there? I think some network issue is there. Mr. Niranjan sir.
Yeah, no problem.
Some network issue. Any
Hello?
more question?
Yeah, hello.
Yeah, Shivani.
Yeah, sorry, I don't know what happened. So basically, I was going on the tangent of bank relationship managers, because we keep having connections with them. They keep calling. So are these people reliable to ask for advice?
See, everyone will be there, so you'll have to see what kind of objectives, how they are comfortable you are with different kind of people, right? Because a banker will have his other targets also. That is also there. And an independent financial advisor will be focusing exclusively upon your financial investments only. Then you'll have to evaluate as to who will be a better person for you.
Right.
In fact,
Yeah.
sir, what I feel, sir, in fact, what I feel earlier, because the same way I started with that SBI, and what I found that SBI is just advising me the fund related to SBI only. But in the market, lots of funds are available which are giving me the better return more than SBI. So means independent advisor can be the right person, because he evaluate all the funds, and whatever the best one is there, it should just pick for you.
Yes. Yes, sir.
I would like to add one point, because we are regularly getting training and all the so many workshops, so many things. So that's why, like, the organization are giving us training how to give the best advice, how to evaluate the funds. So that's why, like, advisor works.
Sure. Yeah. Thank you so much.
Any more question from anyone?
I am Ganesh Murugan here. I am new to mutual fund. So I have one more question, that is there investor have the flexibility to choose the particular sector for investment? Example, suppose I want my investment should be on the power, oil and cement or infrastructure sector. Whether is there options available in the SIP to choose the sector on investor wish, or how it will happen?
Ganesh, yes, we have got a category of funds known as sectoral funds or thematic funds.